In today's video, we are going to look at a case study where an individual is interested in a whole life insurance policy. They were referred to us by a friend. So someone who's been working with us for a long time. This individual is actually a CPA that works for the SEC, so he's got a deep knowledge of finance and numbers and such. But he referred this individual, the person's interested in a cash value life insurance product, but they had some questions with respect to how much they wanted to pay into the policy and how they wanted to actually get the money into the policy. Meaning they did not want to take out a policy and be locked in or committed to paying a fixed dollar amount every single year. So what we'll go through is the different options we prepared, how we presented them, and then also we'll go through the actual companies and products we showed just to provide awareness. This way, if you're interested in a whole life insurance policy, you want maximum cash value, but you just want to make sure you get everything right in terms of company and product selection, and you want to have enough awareness so you don't get in one option and then you see a shinier product after the fact and say, man, I wish I would have known about that option and I would have went with that. That's the purpose of today's video. Let's get on into it and have some fun. So what we have here is a female, age 53, again, interested in a whole life insurance policy similar to what her friend has. So her friend has a policy as follows. He's got a minimum premium of about $6,000 per year. So that's his approximate minimum commitment. It's a little bit higher than that with all of the riders and such. The true minimum is about $7,000 per year. But 6 to 7K is the minimum. However, he funds approximately $60,000 per year. He's been doing that, and his plan is to fund that $60,000 per year for 10 years. So that's a total of $600,000, and it could end up being a little bit more than that. Now, here's a big thing. That policy is flexible. So her friend is committed to about $6,000 per year, but can fund up to $60,000 per year if he's able to. And he's been able to since starting the policy. So a big thing here is flexibility, where he wanted the ability to pay up to $60,000 per year, but he only wanted to be billed for a minimum amount. This way the policy does not feel like a burden, but when it comes time to maximize the cash value, he can do that, provided his finances allow him to do so. So she's in a slightly different position. She can start the policy off with $100,000 right out of the gates. She's got some money in excess cash. However, after the first year deposit of $100,000 is made, the funding amount she's trying to figure out is somewhere in this range, between $30,000 and $60,000. First, she asked, can I see illustrations with $60,000 per year? Because that's what my friend has. That's where that started. But then in talking to her, she also said $30,000 per year. Here's the question I asked her, and I would encourage you to ask yourself. What is the maximum? Specifically, what is the maximum dollar amount you'd like to pay into the policy on any given year, excluding a lump sum if you're starting out with a large amount? So if you're starting out with $100,000 and you think that you'll never be able to get $100,000 into the policy on any single year again, I would not look at the lump sum as far as the maximum. What I would look at, or the question I would ask is, aside from the lump sum, what's the most that you feel you could get into the policy on any given year, that stretch amount? And we won't hold you to that, but why that is beneficial to know is when we design the policy, we want to know the rules of the game. And here's what I mean when I say this. All insurance companies have different limits. You'll see, and we're going to go through this shortly, you'll see that your money can go toward premium or different riders. And the name of the game is minimizing the insurance expenses as low as the insurance company will allow, the IRS will allow, and beefing up that cash value, getting as much of your money as we legally can directed toward the cash value. So this is where this question, what's my maximum or what's your maximum, really helps us. Because if you said to me, $60,000 on any given year, Steve, is the maximum I'm going to pay in, and that might even be a stretch. Well, what I know I can do then is set that minimum premium at about $6,000. This way you're committed to $6,000, but can add up to $60,000. If you said $30,000 is my maximum, or if that's what she said, what's your minimum? it's going to be about $3,000 per year, and then you can pay up to $30,000 per year. We're going to look at models that display just that shortly. So the funding options we'll look at are exactly that. We'll look at option A, $100K lump sum with $60,000 per year thereafter, and then option B, $100,000 lump sum with $30,000 per year thereafter. We'll look at Mass Mutual and Guardian, two of the major mutual companies that we've seen consistent proof of performance when reviewing the cash value growth. So let's talk about the rules of the game a little bit. And the first thing we'll look at is policy design, which is one of my favorite things to talk about when it comes to whole life insurance. So if she's paying in $60,000 per year, where's that money going? Because you can actually choose where it goes. It can go toward two primary areas. One, I can direct it toward the premium, or two, I can direct it toward what is called a PUA, stands for Paid Up Additions Rider. Now the premium might be a little bit higher because we'll also have what is called a term insurance rider attached. The purpose of a term insurance rider is to increase the death benefit at the lowest cost. And why that's important, if one says, hey, I don't really care about the death benefit has a direct relationship to the MEC limit. So if she said, hey, I want to start with this $100,000 lump sum, I need a death benefit high enough to accommodate a MEC limit. We've got other videos specifically on policy design that discuss the MEC limit. But to give you the simple version here, we want the minimum insurance expense in order to get the needed MEC limit. And as long as my policy does not become a MEC, I can use the cash value on a tax-free basis much, much easier. So premium dollars typically do not show up in cash value in the first year and sometimes the first and second year. So knowing the rules of the game, what I want to be aware of is minimizing that premium as low as I can based on the insurance company limits. You'll find the major mutual companies, a lot of times I can reduce it to as low as 10%, with some exceptions there, which we're going to go through shortly. PUAs, the majority will show up in cash value. When I say majority, typically between 90 and 95% in the first year. That begins compounding, that accelerates the cash value growth of a policy. This is really the key to maximizing the cash value on a life insurance policy. So if a 10% premium is my minimum, I'm looking to get the premium that low. If a 5% premium is the minimum, as low as the insurance company will allow, that's how low I'm looking to set it. If it's 25% based on the particular insurance company I'm looking at, that's how low I'm looking to set it. What we've found is when a premium is minimized, that maximizes the cash value, especially on a guaranteed basis. But when we look at proof of performance, meaning not just illustrations, but policies that have lived the test of time, we've seen the strongest results with low premium designs. So let's look at Mass Mutual and Guardian, and we'll discuss how these policies will be designed and also a slight exception to the rule, a partial exception, I should say. So option A here, or funding scenario A, if I want to fund a $100,000 lump sum and $60,000 per year thereafter with Mass Mutual, because I'm funding $100,000 out of the gates, my minimum premium, this is also referred to as my base premium, can be as low as about $10,000. I might be able to get it slightly lower than that, but typically right around 10% of the total annual payment is as low as the base premium can be. So $100K in year one, 10% is $10,000. Okay, $60K per year thereafter. So the first year, I pay in $100K. Where's the money going? Your premium is $10K. It's a little bit more than that with the term rider and such, but you'll see the exact numbers in a minute. Premium is $10K, and we're plowing the rest into PUAs. How about year two? So beginning the second year, if you're funding $60K, where's your premium? The premium is still $10,000. The premium typically cannot be adjusted after the fact. It's difficult to do. So now, of my $60,000 annual payment or annual funding, $10,000 is the base premium. What happens if you go with option B, which is a $100K lump sum, but $30K per year thereafter? Well, they're going to have the exact same design where the premium is going to be $10,000 because your first year payment was $100,000. So now, when year 2 rolls around, the maximum she pays every year is $30,000. You've got $10,000 going toward the premium, which is a bit high in my opinion. For a $30,000 annual payment, you've got about a third of that directed toward the premium piece, which is high. That is not going to result in the highest cash value we could possibly attain. So with all that said, how's Guardian work? Well, Guardian has a similar 10x rule. With Guardian, wherever I set the base premium, I can pay 10x the base premium in PUAs. So right around 10% or a little bit less, I can set the true base premium. But the first year can actually scale my PUA payment all the way up to 50x the base premium. So what that means is if I only have a lump sum in the first year, 100K goes in, and then 60K per year thereafter, and then down here, 100K in the first year, and then 30K per year after, where would you set the premium here? Because you're only funding this large lump sum in year 1. Here, be at about $6,000. Or here, be at about $3,000. So what's nice here, especially if she wants more flexibility, what she can do is carry a much lower premium, which allows her to commit to a lower amount, not have the $10,000 minimum like she would with MassMutual. And then here's a difference with Guardian as well, which is not important to everyone, but it's definitely good to be aware of. I can commit to the premium only. So let's assume I select option B, which is the $3,000 per year option, with $3,000 per year premium. I can pay that annually. Might come out to $4,000 with the riders and such, but that's what I'm committed to. And then 100% at my discretion, I can add more money into PUAs, totaling $30,000, but I'm not obligated to hit that number. So we're turning it into a flexible savings asset where you can commit to a small amount and add more funds to the policy at your discretion, which is nice. A lot of people like that type of flexibility because it takes the burden feeling away, which I 100% get. With MassMutual, you do have flexibility, but it's not the same where you can just commit to the small premium and dump more money into PUAs at your discretion. Where they work really well is if I'm adjusting my payment one time per year and the adjustment occurs on my premium due date or my policy anniversary date. So how that would work is if in year 1, I started out with 100K, year 2 comes, I say, hey, I can only fund $20,000. What we would do is on the due date, we would adjust the premium, the total premium and PUA combined, to $20,000, and we would adjust it each year. So let's take a look at some of the numbers here. This will be fun. First, we'll just check out the designs here. So here's the MassMutual design, and this is the $30,000 per year option. Here's the annual outlay, 100 in the first year, then 30K per year through year 10. Which she did say that's about the longest she wants to fund, 10 years, maybe even stop earlier, which she can easily do with this. But breakdown, where's the money going? Here's your premium, $10,000. Then you've got PUA and term riders. We do have videos that break down detailed illustrations, but if you're just looking for the quick notes here, here's your total cash value. First year, 89% of your total payment. 100 goes in, you've got $89,000 in cash value. When people ask, what are the drawbacks to these policies? This is it. First year, I take that hit. And how long does it take to recapture your money when you look at it here? So here, pay another 120. So 120 plus 100 is $220,000. So by year 5, you've paid in a total of 220, and there's your cash value. So by year 5, you've recaptured your total payments. That's your break-even point, when your cash value is equal to the total payments you've made over time. And then it keeps getting better as the years pass. The death benefit is actually a clean number of $1.2 million. How we came up with that number is because it gives us a MEC limit of $100,000 in this example. So look at this up top. And look at the next illustration. looks identical. Let's go back to the 30, then to this one. Identical up top, but the difference is this. Same policy, but with $60,000 per year. So one of the nice things about the MassMutual product is if she's uncertain or feels some years she might be able to go up to 60K and then some years it'll be 30, the design is exactly the same from day one. And this dollar amount, we see 60 every year here, this can adjust every year. This is something we do when we're working with clients, when we have review meetings and such, discuss how it's going with the funding, and if they want to adjust it, we adjust it. It's very simple. We do this on the back end with the insurance company, meaning we work with the home office, and then once the amount is updated, the billing amount, the client receives notification and they can pay it right online. So it's very convenient in that respect. Then we've got the Guardian policies. So let's look at the $60,000 per year one first here. And what's the difference? So from a funding standpoint, it's exactly the same. 100 in the first year and then 60 per year thereafter. Instead of a $10,000 premium, you're $6,000. We do have this term insurance rider attached. Here's the cost. So the true minimum would be those two combined. If we round up, call it $1,000, or I'm sorry, $7,000. And then the rest, we're plowing into PUAs, paid up additions. First year, 100 goes in. There's your cash value, 91,000. Look at year two. You're at 91,000 at the end of year one. You added 60 to it. If you add 60 to 91, what does it equal? 151. What's the value? 153, 377, which means I got my 60K back and a little bit more on top of it. What's the worst year of a life insurance policy when we're looking at the cash value? The first year. What are the best years? Every year after the first year, when I see more and more of my money come back. In this example, the premium is overcharged in the first year. Beginning the second year, we start to see the majority of that come back to work for us. The policy's compounding, PUAs are going into the policy. It looks fantastic. Break-even point on this one, between years 3 and 4 when we look at it. Remember, when we look at MassMutual, the premium was the same policy. With Guardian, is it the same? No. First year is a bit higher. You're at just about 94%. Here's the difference. Here's your premium. Instead of 6,000, you're at 3,000. Now we did have to add more term insurance to the policy. Remember the purpose of term? Cost-effective way to raise the death benefit and raise the MEC limit, preventing a taxable event. But much more lucrative upfront here. So good option to be aware of. Then each year, we've got 30K per year going in instead of 60. But if she says, hey, I want to start a bit more conservative with a maximum of 30 per year instead of 60, this is a good option, especially if she likes the idea of keeping a low premium commitment. So as we compare these guys, which we like to do, now if we want to get very analytical, we could look at the guaranteed values here too. But as we look at the first several years here, there's not much of a difference. And what I'll say about this too, these are based on illustrations when we're looking at the comparison we have up on the screen. As time passes, whatever we see on an illustration, those values do change. We like to measure the performance year over year. And if you're nerdy, what we like to do is track what the original illustration looked like compared to the actual results. But looking at this, they're very similar for, call it, the first 10 years. MassMutual does have a higher dividend rate right now, so it is going to illustrate more attractive numbers as time passes. But I can look at them side by side in addition to the illustrations we looked at and begin to refine my decision-making process. I've got the 60, then the 30, and this individual narrowed things down to Guardian. And here's what we've got. So here's a nice exercise I like to take folks through that are having a hard time deciding how big they want to go. So here's a policy that allows up to 60K per year, the $6,000 minimum premium. You've got two illustrations. Is anything different about these two? No. Well, the funding is, but the design is identical. There's your premium, there's your death benefit, there's your cash value in the first year. Exact same in the first year. These are demonstrating what the results might look like if I only funded $30,000. And then what I would compare that to is the policy with the $3,000 minimum. So here, instead of a $6,000 minimum, what do I have? A $3,000 minimum. Ah, look at that. How much more value do I have in my policy when I pay the exact same dollar amount in, but go with a lower premium? Not that much in this case, is it? No. If we look at the guaranteed values, they'll be slightly different, but there's not much of a difference here. So in a case like this, if it's me, I would actually gravitate toward this option with the $6,000 premium, just because I know I have the ability to add up to $60,000 per year. I would only go with this option, the $3K minimum, if I said there's no possible way I'm going to add more than $30,000 per year. But that's what we want to discuss. And things to discuss are really, how do you feel when you see the minimum? Is $3,000. When you see that number, is it a minimum that you look at and say, hey, that doesn't bother me at all? What about $6,000? Do you look at that and say, I might feel that a little bit. I don't know if I'm going to go up to 60. Well, then the 3K minimum likely makes more sense. Maybe it's a 4 or 5, whatever it might be. But asking questions and progressing through the different scenarios often helps someone make that decision. Unless you just see the numbers and say, I like that one. What are the next steps? Which some people are there, which is perfectly fine. Everyone starts out at a different spot. So I do hope that this helps. Let us know if you have any questions. Please feel free to leave them in the comments below. And as always, I hope this helps. We'll talk to you soon. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.